Welcome everyone to our ongoing series here on the different COVID relief measures. You probably recognize me from PPP land, and I'm here today definitely to give you an update on the PPP, but also fortunate to be joined by a couple of my fellow partners who are very well versed in the ERC, the Employee Retention Credit. So Jim Donovan is my fellow partner, then Joe Stoddard as well, both part of our National Tax Office. You know, our normal day jobs are not COVID relief, but just like I was volunteered for the PPP, Jim and Joe kind of stepped in to cover the employee retention credit. So again, thanks everyone for joining today, and hopefully, I know questions will come in through the chat box and through the Q&A. Hopefully we cover some of these questions during our presentation. If we're not able to get to those questions, we'll try to follow up afterwards. Usually the case is that so many questions come in that we're just not able to get to them. So rest assured, we'll try to cover them either during the presentation or again, someone will follow up afterwards. So agenda today, we're gonna have a little back and forth here, but I'll start it off a couple of minutes on the PPP updates. And then Jim is gonna step in and give us a refresher on the employee retention credit. And then I think Jim and Joe are gonna actually, no, I will step in and talk about how the employee retention credit interfaces with the PPP, and then back to Jim and Joe for some of the covering the new guidance that we have out there on the employee retention credit. So specific to PPP, Paycheck Protection Program first, there was an update that came out 3 or 4 weeks ago. It started with the current administration. The Biden administration had put this change out there. And originally, if you were what we call a sole proprietor is someone that files their taxes, their business taxes on their own return. There isn't an entity in between. So they're like a Schedule C filer is often what we call that because the activity is reflected on their Schedule C. Originally, when you compute the amount of PPP loan, a Schedule C filer could use actual payroll. So if they have other employees on the payroll, because a Schedule C filer cannot also pay themselves a wage, the SBA originally said, well, you can use a share of your net income as a surrogate basically for payroll. And they called it the owner compensation replacement. And so that was important both for purposes of calculating payroll upfront for determining the size of the loan, and then also important for forgiveness purposes. At the end of last year, at the end of December of 2020, Congress came out with PPP round 2. And one of the things Congress did is said that Schedule F filers, which are farmers, can use gross income as their owner replacement amount rather than net. And the Biden administration through the SBA recently expanded this use of gross income now to Schedule C filers. So if you're a Schedule C filer, if you're a sole proprietor, you can use either your net profit on the Schedule C or your gross income on the Schedule C. So if you're a Schedule C filer without any net income, you would look to your gross amounts to compute the owner compensation replacement. Now just remember, this isn't limitless here. Ultimately, the owner compensation replacement amount is capped at $20,833, no matter if you use net or gross. So if you have 100,000 of gross, this doesn't mean that you're going to be able to use, 200,000 of owner compensation replacement. It's still capped at that amount. So this change is really going to benefit people that are minimally to not profitable. They can look to their gross, similar to how Schedule F filers would be able to do it. Also, a new FAQ came out. So I call it the ongoing saga of the forms 3509 and 3510. These are the so-called loan necessity questionnaires. Everyone with a loan of over 2 million has probably received this form. Usually what happens is you submit your forgiveness application to your lender. Lender comes back and gives you this form 3509 for profit, 3510 for not-for-profit, and lender says you have 10 days to answer 6 pages worth of questions and provide kind of accompanying documentation. And this all goes back to the government somehow was retroactively questioning people whether they had adequate basis in the first place to receive the first round of PPP loan. You've heard me before, and I'll just say it again. I think it's very bad policy from the government because this retroactive rulemaking, where back in March and April, the government told everyone, hey, get this loan, March and April of 2020, get this loan. it's the height of the COVID emergency, just get the loan. All we're going to ask you to do is maintain payroll. Everyone did that. And suddenly now the government's backtracking for certain borrowers. So anyways, people have filled out these 3509s, 3510s. And the question all of our clients have is, well, what is the government doing with this information? We didn't know. I think we still don't know. But what the government did say here in the new FAQ is that it is basically a facts and circumstances analysis, the government's review of each borrower's certification, meaning the information on each of these forms, 3509 and 3510, is somehow individually weighed. And from that, there could be further governmental review. And I guess the important point for those of you out there looking at this issue is the government also confirmed, though, that if the government does decide to follow up on the 3509 or 3510, meaning further review, you will have an additional opportunity to appeal or to protest. So it's not end of story. The government isn't going to swoop in and say forgiveness denied. They're going to swoop in and say something to the effect that we reviewed your form, we have further questions, and a borrower at that point will have additional opportunity to provide more information. Beyond that, though, we still don't know. To our knowledge, we have not heard of anyone with a loan of over $2 million whose forgiveness application has been approved by the SBA. Certainly, I know lenders have approved it, but remember, the lender approves it and then sends it to the SBA. And we are not aware of any loan yet that's been fully paid off by the SBA for a loan in excess of $2 million. If there are someone out there, I'd be interested to hear how that went. And then finally, currently right now, PPP, both round 1 and round 2, is scheduled to close on March 31st, so in 20 days. And many banks, I think even Bank of America and several other large banks, have stopped taking new applications because their concern is if they start a new application right now, they may not even be able to close the loan by March 31st. And their worry is somehow that they'd be left hanging out to dry by the SBA. So effectively, the program is kind of shut down. Hopefully, everyone that needed a loan has already gotten in, but there is a push in Congress. I just saw today the House of Representatives has a bill up to extend the PPP by a few more months. Hopefully they do this, and I would assume the Senate would pass it pretty quickly, and I would assume Biden would sign it into law pretty quickly to push this closing date out by a few months. And the other thing to pay attention to there is they can never resist, they being Congress, if they're going to extend the due date, I'm sure that they can't resist making some type of modification to the program along with it. And maybe they'll make it more generous for certain borrowers. So just stay tuned to that. And with that, I will turn it over to Jim Donovan.
Awesome. Thank you, Adam. So one of the main reasons for this webinar is to address the new guidance that came out on March 1 around the employee retention credit. And the PPP Interplay is a large part of that, which Adam will get into in a little bit here. While notice to her 2021-20 included a lot of copy and paste from the FAQs, they did provide us with some new guidance outside of that PPP ERC Interplay. And some of that guidance narrows the definition of an eligible employer, specifically under the suspension of operations test. They also throw in some other bits of guidance that we'll highlight for you today. So I should mention that notice 2021-20, I got to stop saying that, only applies to the 2020 employee retention credit. We anticipate there's going to be more guidance. I know you guys are tired of me saying, hey, we're waiting for guidance, right? But there will be more guidance around the 2021 ERC. And with that, I'm going to start with some important concepts or takeaways here. Just their themes that you should pay attention to as we kind of work through this and get into the weeds. So on its face, the employee retention credit's a basic 50 or 70% of the credit on wages paid, right? But once you dig into the details, you find that, or have found, it's complex. There's a lot of nuances here that can trip you up. So there's some themes here that I just want to hit on, again, to pay attention to as we work through the slides. So some important concepts include, who is an eligible employer? You can qualify in one of two ways. There's a full or partial suspension of business due to a government order. That's the squishy part of the law. Or there's a significant decline in gross receipts. That's the bright line test. So again, there's two ways to qualify. It's not an and test, it's an or test. The other thing to consider here is what is a small employer versus a large employer. Small employers can claim the ERC on everyone. So for all wages paid during the eligibility period, up to that 10K max, you can qualify. If you're deemed to be a large employer, you can only claim the ERC for wages paid to employees who are not providing services. So, if you have the admin person who's getting paid full time, for example, but only working 50% of the time, you can only pick up 50% of his or her wages for the credit. So again, there's a big difference in the value of the credit if you're a small or large employer. The final piece, can't harp on this one enough, it's a refundable credit. So yes, it offsets your Social Security tax, basically all your payroll taxes, right? But any excess is refunded to you. So again, it's a really nice benefit here. All right, so I know this feels a little out of order, but we're going to get into the weeds here in a few minutes. So I thought, you know what, I should probably hit on how to claim the credit before we get too deep. I don't want anyone's eyes glossing over and they miss out on this point. So the first thing to note here is there's no immediate deadline. We have a statute of limitations of at least 3 years, maybe a little bit longer. I'll let Joe get into that, from basically the time the payroll tax return is filed, right? So there's no immediate deadline. You have plenty of time. It's not like PPP where they're going to run out of money. If you claim the credit and you qualify for the credit, you're going to get the cash. So, there are some reasons to do it sooner versus later, and we'll get into that in a little bit too. But just a quick reminder on how to claim the credit, right? You can, one, file for the credit on your 941. You can amend your 941 for the credit, and you have to, especially for 2020, right? If you qualify in Q2 and you're taking the credit for Q2, you got to go back and amend that Q2 941. You can also, and this is for 2021, you can adjust your remittance payments. So maybe you're paying in bi-weekly, right? You can actually reduce those payments and monetize your credit now. The third thing is that you could file Form 7200 for advance payment. There are a lot of rules around that. There's certain tests you need to meet to qualify for that, but just know it's out there. And that's something your CPA or iBailey can help you with. So those are again, just some things you need to know as far as claiming the credit. All right, so let's talk about the basics. I've looked through the registration list and I can tell that I know that some of you are new to the ERC and you're seeing this for the first time. I know that others of you are pretty far down the path. So this is going to be a little bit of a refresher, but it's really good to understand the difference in the rules for 2020 versus 2021. And really, again, the value of the credit changes significantly. So we'll go ahead and hit these over the next 2 slides. The first thing you need to know is really the time period, right? So the CARES Act provided us with the employee retention credit. And basically, the way I look at this is I'm looking at qualified periods. And really 2020 from March 13th through the end of the year is your first qualified period. And that's because you can only get to that max of 10K in wages per employee through that entire time. In 2021, we have the credit available for the first 2 quarters. That may be extended now through the end of the year. Again, I don't want to steal Joe's thunder there. But really, I look at that as 2 periods because we can take the credit in Q1, again in Q2. So it's more valuable in 2021 versus 2020. The other thing to note is the credit rate change. So it was a 50% credit in 2020, and now it's a 70% credit in 2021. Again, and with the Consolidated Appropriations Act that was signed on December 27th of last year, it really upped the benefit of the credit, breaking it into a quarterly computation and then increasing that credit rate. Now, some things that didn't change is qualified wages. You can only qualify up to $10,000 per employee. So that again doesn't change, other than the fact that it's per period or per quarter in 21 versus basically over that 9-month plus period in 2020. So if you can do the math at home, the maximum credit is $5,000 per employee. in 2020, and then 7,000 per quarter in 2021. Remember on the last or 2 slides ago when I talked about important concepts, what does it take to be an eligible small employer, right? And the benefit of being an eligible small employer is you can take the ERC on everybody versus only those who are being paid but not providing services. So in 2020, that definition is 100 or fewer full-time employees. And a full-time employee is defined as someone who is working at least 30 hours a week or 130 hours a month. And basically you compute a calculation over 2019, it's kind of the last normal year, looking only at your full-time employees, not full-time equivalents. It's a different calculation versus PPP, just full-time employees. And if you meet that 100 or less, again, you can take the ERC on everybody. In 2021, that number is increased. So now we're looking at 500 or fewer employees, and you can take the ERC on everybody. So if you're in that 100 to 499 range, your credit can be quite significant. Again, not having to look at, gosh, who's being paid but not providing services, and $7,000 per employee per quarter, it adds up very quickly. All right. This second page, again, more of the just kind of the background here, comparison of 2020 to 2021. In terms of eligibility requirements, again, I told you there was a 2-part test, or it's an OR test, right? And one is that suspension of operations. The other is that bright line test, that decline in gross receipts. So in 2020, you needed a decline of greater than 50% in any quarter of 2020 versus 2019. And I do have an example in a couple of slides. In 2021, that decline only needs to be 20% or more than 20%. And again, we're still comparing 2021 to 2019, that quote unquote normal year, right? So in most cases, that should be a better answer. The other thing that the new law gave us was a look back provision. So this wasn't applicable in 2020, but in 2021, basically there's 2 ways to qualify for each quarter. So in 2021, we can look at Q1, compare that to Q1 of 2019. If you meet that 20% drop in gross receipts, you qualify for Q1. Alternatively, you can look back at the preceding quarter. And so you would look back at Q4 of 2020 and compare that to Q4 of 2019. If you meet that greater than 20% decline in gross receipts, you automatically qualify for Q1 of 2021. So it's a way to pre-qualify really for each quarter. So, in my mind, if you qualify for Q1 of 2021 with the Q1 2021 versus Q1 2019, you should probably qualify for Q2 because of that look back. Now we'll see if the guidance says, hey, you have to look back each quarter, or, again, we'll find out. But with something to watch for. The gross receipts definition, love to throw some code sections at you guys. So for for-profit organizations, that definition of gross receipts is under 448C, which is fairly inclusive. So just be aware of that. If you're a not-for-profit organization, that definition of gross receipts is under 6033, or in layman's terms, it's basically what you would report on Form 990. So again, that's what you need to know about gross receipts. In terms of suspension of operations, the rules, I believe, will be very similar in terms of qualifying. The important thing here is it's a little bit different than qualifying under gross receipts. If you qualify under gross receipts, you qualify for an entire quarter. If you qualify under the suspension of operations, you only qualify while the government order is in effect suspending your operations. And again, we'll get into that in a little more detail in a few minutes here. The other thing to note in 2020 versus 2021, government instrumentalities generally weren't eligible. There's kind of a 6-pronged test that you can look at to potentially qualify, but for the most part, they're not qualified for the ERC. In 2021, the credit was expanded. So public colleges, universities, organizations whose principal purpose is providing medical or hospital care, You know, and other things like credit unions can qualify for the ERC. So they expanded it a little bit, but they didn't go all the way and say, hey, all government instrumentalities qualify. So if you fall in that bucket, or you know, you have a question, you probably should reach out to an expert and say, hey, do we qualify for this? All right. So qualified wages, right? You're saying, gosh, Jim, what makes up that $10,000? And so really what we can look at are, or what the law gives us, is we can look at wages that are subject to Social Security tax. So on the slide, we have, you know, Form W-2 Box 3 wages. We have since learned that Box 7 wages, which are tips, also qualify, you know, also subject to Social Security tax. So we continue to learn as this thing evolves. The other thing to note here is that wages can't exceed an amount. Well, again, this is for 2020. Let me preface this. If you're over that 100 employees, basically you can't pay your people a bunch of bonuses to up your ERC. So there's kind of a 30-day period that you have to look back to and say, hey, do we pay our people any more in this current period versus that 30-day prior period? Again, for purposes of, you know, grossing up our ERC, and you can't do that. If you're less than that 100 employees, that rule doesn't apply. You know, the other thing that, you know, we kind of covered the eligible small employer, but it does bear just mentioning again here. It is a big deal. And I've had several calls with companies that are right on that line. You know, looking back at 2019, you know, how close are they to that 500 employee or that 100 employee limit? You know, we've had some clients look at their 1094C, that ACA form. I will say that I've been told those aren't necessarily accurate. I recommend doing a calculation to see if you qualify and then documenting that, especially if you're very close. The other thing I'll mention on this slide here is that family members, right? If you are a greater than 50% owner of an organization, wages paid to your family members are excluded. And that, you know, mother-in-law, father-in-law, sister, brother, cousin, they're all out. We can't pull those wages in. What's interesting is, at least based on our reading of the guidance, is the wages for the owner and the owner's spouse can be pulled in. Now, these are only, again, W-2 Box 3 wages. We can't pull in wages that are subject to self-employment tax, but that's something to consider. You know, I think the accounting firms are a little split on that. And again, it depends on how you read that, but I think that's where we're shaking out right now based on the available guidance. All right. The other thing we can pull in to help get you to that $10,000 max per employee is health plan expenses. And so health plan expenses really kind of fall into a couple categories, right? So one, you have the employee portion of your health plan's costs. And these are their pre-tax contributions. Those can be pulled into the ERC, as well as the employer portion that you pay for these employees. And again, you need to do that calculation just like wages on a per employee basis. The other thing to consider here is, gosh, if you're self-insured, right? You know, how do I basically break this cost out? What the guidance provides is there's flexibility here. You know, any kind of a reasonable pro rata approach to that is acceptable, even using COBRA rates. So again, if you have questions on that, I recommend you talk to an advisor, but just know that there's a way to capture those costs. The other thing to note here is health plan costs for furloughed employees are includable. So even though you're not paying them wages, you can pull these in. Now, the important thing here is, right, if you're over 100 employees, they're getting paid with health plan expenses, but they're not providing services. So if you're over that 100 employee threshold, this is one way to get some ERC, right, is with these furloughed employees and the health plan expenses you paid for them. All right. So I promised you guys basically a slide with an example on the gross receipts test. Just remember that 2021 is on a per quarter basis, is how we compute the credit. So we don't have to worry about this convoluted test for 2021. But for 2020, basically it's a fun mental or a fun math game we get to play, right? So I told you that, gosh, any calendar quarter where you drop more than 50% in gross receipts compared to the same quarter in 2019, you start qualifying for the ERC. And because you qualify for a single quarter, you're automatically going to qualify for a second quarter because there's this thing called the rebound quarter, right? And so in our example, gosh, 2020, the year started off okay. Maybe we saw a dip because things started to slow down in mid-March, right? Because of COVID. Q2, man, it just didn't go well. So we see that gross receipts are about 42% of what they were in that same quarter in 2019. So in this case, we now have met that 50% reduction of the gross receipts. We qualify for the ERC. We can start pulling in wages for the ERC, right? Now, you still qualify in Q3, even though you don't meet the gross receipts test in Q3. And basically what the law says is you're kicked out of claiming the ERC in the quarter after you rebound above 80% of gross receipts in the same quarter versus 2019. So in our example here, we see we rebounded in Q3. And what that does is that kicks us out of Q4, but we're eligible to claim the ERC in Q2 and Q3. I know it's a confusing concept. That's why I love the example. I get a ton of questions on it, but just know if you qualify for one quarter in 2020, you're automatically going to qualify for two unless it's Q4. But if you qualify in Q4, you're going to qualify in Q1 of 2021. So again, with the reduced rules. So that's what you need to know on the gross receipts test. Aggregation rules do apply. So if you're part of a controlled group, we need to look at the entire controlled group. And that implies for the 100 versus 500 employees as well. I failed to mention that earlier, but something to keep in mind. All right. Last thing I want to talk about before I hand it back to Adam is that the suspension of operations, right? So I talked about there's two ways to qualify. This suspension of operations, this is a squishy part of the law, and I'll spend a lot more time later in this presentation around the new guidance, but wanted to give you a quick overview right now. In the original law, if your organization was fully or partially suspended due to an appropriate government order limiting commerce, travel, or group meetings due to COVID-19, you qualify for the credit. It's broad, it's fantastic. It's hard to think of an organization that wouldn't qualify, right? Now, the initial FAQs narrow this broad definition, and let's be honest, they were still ambiguous. But with the new guidance, we have a further narrowing of the law, and I don't think anyone's surprised by that. I guess the law was so broad that they needed to, narrow it a little bit, right? So let's talk about, what is a suspension of operation. And first of all, you have to have a government order. And so those are orders or proclamations or decrees from the government. And that could be a state or a local, a county government really saying, hey, these operations are suspended. You can't operate between these hours. They are official statements. Things the governor makes in a press conference don't qualify. As of right now, general guidance by the CDC, their recommendations, they're not really governmental orders. We may see that changed in the next round of guidance because I know there's some lobbying groups out there working towards that. But that's where we stand right now. The other thing to note is that the FAQs initially, well, and they still do, they really define two types of businesses. One, there's an essential business, and two, there's a non-essential business, right? So if you're an essential business, as deemed by the state or county, et cetera, it's a little bit tougher to qualify just because your hours weren't potentially reduced or, you're required to stay open, right? But it doesn't automatically disqualify you from being a qualified or eligible employer. So, if hours of operation were limited or other things we'll get into a little bit later occurred, you can still potentially qualify. One of the examples they gave is if you're a manufacturer and you can't get supplies because your suppliers are shut down, they're non-essential businesses, you would qualify for the credit. So again, just know if you're an essential business, you're not automatically precluded from taking advantage of the ERC. The other thing I'll note here is some things were deemed, hey, you're not partially suspended, right? If you can go home and telework and everybody can and did beforehand, that's not going to qualify, right? Even though your place of business is shut down. The other thing that I know frustrates a lot of clients is, just because your customers were required to stay at home and that impacted your business, that doesn't qualify as a full or partial shutdown. Basically, what the guidance says is you need to meet the gross receipts test in that case. So again, this is kind of the overview of the original law, and we'll get into the weeds on some of this a little bit later, but hopefully gives you enough background. And what I'm planning to do now is, I believe we have a polling question, and then I'm going to hand it over to Adam, who's really, I know you guys are super stoked about the PPP ERC overlap and how we can maximize benefit for each of those. So Adam, you're up next.
Thank you, Jim. So this is what I call, PPP and ERC interplay. Why do we use those terms? Well, as Jim mentioned, the ERC was created originally as part of the CARES Act in March of 2020. CARES Act also created the PPP. Originally, Congress said those two programs are mutually exclusive, that if you take a PPP loan, you cannot also claim an ERC, the Employee Retention Credit. And given that at the time, the PPP dollar for dollar was free money, almost everyone, if they were eligible anyways, took a PPP loan and just assuming that they weren't going to get the Employee Retention Credit, and so be it. But the Consolidated Appropriations Act 2021 passed in December of 2020 undid that mutual exclusivity so that PPP and ERC can now work together. And even more, that they undid the mutual exclusivity was undid retroactively to 2020. So both PPP round 1 and PPP round 2 borrowers can now claim the Employee Retention Credit going back to 2020, assuming that they're eligible. The important point is, or the important disclaimer is that wages can't be double counted. So if you have wages on your PPP forgiveness application, giving rise to PPP forgiveness, you can't use those same wages for ERC purposes. Well, that begets the obvious question of, well, how do you apportion wages between the two? Because the PPP covered period typically is 24 weeks, and that's going to overlap in many cases with a quarter that a borrower wants to use the ERC for. So you have a PPP covered period that overlaps with an ERC quarter. You're going to use wages for PPP. You're also going to use wages for ERC. You know that you're not going to need all of the wages during that 24-week covered period for PPP purposes. But how do you apportion between those two programs? And up to a week ago, 2 weeks ago, the answer was we really didn't know necessarily. And as Jim mentioned, this Notice 2021-29 provides a bunch of additional ERC guidance. What it also did was help us understand how the PPP and the ERC work together for purposes of apportioning the wage expense. And what it basically does is an eligible employer, so if you're eligible for the ERC, you're deemed to have elected not to include ERC qualified wages up to the amount of payroll costs that you need for PPP forgiveness purposes. Now that's kind of a mouthful. We're going to have some examples here in a second, but I think this works the way, it makes sense the way this works, that if you need the wages for forgiveness, they don't count for ERC, but the ERC works for wages for anything in excess of what you need for PPP. So, and also we had this question come up in the Q&A box, but if for whatever reason, if you have a PPP loan that is denied, if forgiveness is denied, either a PPP round 1 or PPP round 2, then you can use those wages for ERC purposes as long as they're otherwise qualified wages. And again, that makes sense because the focus is on forgiveness. It's not just that you got the PPP loan, but it's that you got it forgiven. They don't want the double benefit. So if your loan is not forgiven, you get no benefit. So you could use the wages for ERC purposes if they're qualified. So let's walk quickly through a couple of examples of how this works. And these examples are directly from the notice. And there's some other examples in that notice as well. So I'd refer you back to the notice if you have questions on the details here. But so an employer borrower has a loan of 200 grand. They paid 250 grand of eligible or qualified wages. And in this case, when we say qualified, we mean qualified for ERC purposes. They submitted a forgiveness application listing $250,000 of qualified wages. Note that they didn't put anything else in the forgiveness application. They didn't put rent. They didn't put mortgage. They didn't put anything else. You can do up to 40% of your covered expenditures for PPP can be non-payroll related. They didn't do that here. So what the example says is employer B is deemed to have made an election not to take into account $200,000 of the qualified wages for ERC purposes. And how did they come up with that? Well, they needed those $200,000 of wages to get forgiveness because the PPP loan was 200 grand. The delta, the difference between the total amount of qualified wages and the wages that were necessary for the loan, that $50,000, you can use that amount for ERC purposes. So if you took a lesson out of this, it would be you're deemed to use the wages needed for PPP forgiveness purposes. If you list excess wages in the PPP application, those wages could be used for ERC if they're otherwise qualified wages. So next example, employer C received a loan of 200 grand again, paid 200 grand of qualified wages. They also paid they paid 70,000 of other eligible expenses, and eligible would be for PPP purposes. So qualified overhead, qualified rent, mortgage, etc. Importantly though, when they submitted their PPP loan application, they only put the payroll on the forgiveness application. They did not put the 70,000 of qualified overhead. Loan was forgiven in full. And what the example says is even though employer C could have put the 70 grand of eligible expenses and the 130 grand of payroll, they didn't do that. They actually only put the 200 grand. And therefore all 200,000 of the wages count for PPP forgiveness purposes, and they do not count for ERC purposes. So lesson learned there, if you have qualified non-payroll expenses for PPP purposes, put them on your application. A lot of people haven't done the non-payroll expenses because payroll is so easy. You submit your payroll report, your ADP report directly to your bank. Bank is familiar with it. You get forgiveness and you think you're good to go. And suddenly now, because you can claim the ERC, you're going to regret if you went that direction. And so even though it may take additional work, I think I would encourage everyone to look back and come up with 40% of your PPP costs. Make sure that they're the non-payroll costs if you also want to claim the ERC, because it'll free up more wages for ERC purposes. So this is the kind of the same example here, just with a modified fact pattern of again, $200,000 loan, they have $200,000 of wages. They put the $70,000 of eligible expenses on the forgiveness application this time. So previous example, they had the $70,000 of expenses of non-payroll overhead expenses, didn't include it on the forgiveness application. This time they did include it on the forgiveness application. And what that does is free up $70,000 of those wages for ERC purposes. So just by putting the $70,000 of overhead expenses on the forgiveness application, you've freed up an additional $70,000 of wages for ERC purposes. So again, lesson learned, if you have them, eligible non-payroll PPP expenditures free up ERC wages. And really my recommendation to most people would be include all of your eligible expenditures on your PPP forgiveness application. Even if you don't think you need them, I don't think they can ever hurt you by putting as many expenditures as you're entitled to on your PPP forgiveness application. One, it may help with forgiveness, but two, as we see here, it could also help with your employee retention credit. And then the third example is a little more complicated, but it just shows what happens if you have a mix of qualified and non-qualified wages, qualified, non-qualified for ERC purposes, how that works if those appear on your PPP forgiveness application. So in the interest of time, you can go back and look at that example, go back and look at the notice to find more details, but I'll move on. So kind of final thoughts on this. There's, with everything, right, we have questions, we get guidance from the IRS, and that raises more questions. So one would be, well, can you just decide if you have a 24-week covered period and you have one quarter, your ERC quarters within that, you have 4 weeks of that you want to use for ERC purposes, can you just decide what wages during your PPP covered period go to PPP and then what wages are freed up for ERC purposes? And we think the answer is yes, that you have a lot of latitude to apportion it between those two. Again, you just can't double count. But, cash is fungible in a sense. In this scenario, wages are fungible. So if you could say the last 8 weeks of the PPP forgiveness, or the PPP covered period, if you can say, I only need 8 weeks of payroll and I'm going to use the last 8 weeks of my covered period, so that the first, whatever, 10 weeks or 15 weeks I can use for ERC, I think there's nothing there saying you can't do that. Maybe we'll get additional guidance out, but it sure seems to say the IRS is saying there's a lot of latitude, just don't double dip. And then also as a reminder, there are certainly wages that are going to be paid that won't be eligible for PPP forgiveness. In the examples I put in here, there's others, but examples, wages in excess of $100,000 on an annual basis. Also, certain wages paid to owners, there's restrictions on those wages. You can still pay them to the owner, it's just that they don't generate forgiveness. So you could have amounts on your payroll report or amounts reported on a W-2 where a portion of it generates PPP forgiveness, but maybe a portion of it does not because it goes over the $100,000 cap or it goes over the owner employee cap. Our read of it now, and I defer to Jim and Joe on this, but our read of it now is you could potentially use that excess portion for ERC. Now, ERC is subject to its own cap, its own per employee cap, but as long as you're still under that cap, you could use, potentially these wages that don't generate PPP for that purpose. I guess, Jim, would you agree with that?
I would agree. That's a great read on that, Adam. And I will work through this a little bit quicker. I know Joe is chomping at the bit to talk. So as I mentioned earlier, we have new guidance in the notice. Outside of Adam, Joe, and I don't think anyone's going to mistake these 102 pages of guidance as a suspense novel. But let's talk about what we have here, right? So the good news is the FAQs were a little ambiguous. We now have clearer guidance. The other thing is it's actually guidance we can rely upon versus the FAQs we couldn't. So in the FAQs, in the guidance, similar to the FAQs, they continue to make this distinction between an essential business and a non-essential business. And basically we have refined rules that define how to qualify under the suspension of business if you're an essential business. And basically, an essential business may be considered to have a partial suspension of operations if, under the facts and circumstances, more than a nominal portion of its business operations are suspended by a government order. Now, we had this nominal language in there before, but it wasn't defined. So the IRS, the IRS in this notice provides kind of two tests that I'll call maybe safe harbors. Basically, if your gross receipts from the portion of the business operations that are suspended is more than 10% of total gross receipts, then basically you could still meet that definition of a partial suspension. The other thing they look at is hours of service performed by employees in that portion of the business that's suspended. If it's not less than 10% of the total number of service hours performed by all employees, and this, I should mention that these are both looking back at the last normal year of 2019, then, or in comparison, then again, you can meet that safe harbor. So, this gross receipts test is different than the other test to qualify, but again, it provides us with a safe harbor to say, gosh, you know what, if this portion of the business is suspended and it makes up more than 10 or at least 10% of hours or revenue, then we can still qualify as an essential business. Now, if we look at a non-essential business, they give us a few more things to look at here, right? You know, basically they give us 4 things. Gosh, can you telework? What's the portability of the job? Is there a need for physical workspace? And the time to transition here. So let's tackle each of these examples. You know, with telework, it's, hey, can you do your job at home, right? The example in the notice is a software company. You know, basically their employees teleworked a few days a week prior to COVID, so they are not they're not going to meet the suspension definition because it was fairly easy for them to pick up and work from home. Now, portability and need for presence in a physical workspace, to me, they go kind of hand in hand. The examples they provide here are, for example, physical therapist, right? Yeah, you can set up Zoom meetings with your clients, but you can't go into the office and work with them on certain pieces of equipment. So again, in that case, you would meet the partial suspension. What about the need for a physical workspace? In this case, or in their example, they provide an organization with a laboratory. You know, yeah, a lot of people could go home and work and do their job, but you have certain scientists that they can't perform physical or perform experiments at home, right? They need to be in the lab. So in that case, since part of that business is suspended, they would meet the suspension of business test. The third thing, or the fourth thing they put in here is this time to transition, right? And it's basically a discussion of how long did it take you to basically take your operations and work from home. And basically it's saying that, you know, if it took more than 2 weeks, then yeah, you're suspended for that 2-week period. You know, it's unclear whether that's continuous or if that's, you know, over a longer period of time. But, you know, there are a lot of companies that had to ramp up their IT and put procedures in place for everyone to work at home. And so it makes sense that they would meet the partial suspension of business test as they set up operations. So again, just some things to consider. It's not an exhaustive list. Again, it's a facts and circumstances case. The other thing they throw in here is this nominal thing again. You know, and again, we're arguing, gosh, it's a safe harbor, right? There may be other factors to consider that, you know, more than a nominal portion of our business is suspended. But again, just be aware that that 10% test still applies to non-essential businesses. So, you know, some of the things that you could consider there are, you know, if you had a restaurant and, you know, now you can't do a buffet, it's carry out only, right? It impacts the way you do business. The other thing that they attack or look at here are modifications. So some examples here are if you merely require people to wear masks, that's a modification of their behavior, or require your people to wear masks, that doesn't qualify as suspension of business. But if there are modifications like keeping tables 6 feet apart in a restaurant, only allowing outdoor dining, those qualify. Retailers that shut down their storefront, those qualify because they're only allowing curbside. However, if you're a retailer and you can limit the number of people in the store and they have to wait in line outside, that doesn't qualify. So again, there's some good examples in here and they're more specific, but just be aware that those are out there. And again, if you have questions, don't hesitate to reach out. And with that, I'm going to hand it over to Joe to talk about some of the other aspects of the new law.
Fantastic. Thanks, Jim. All right. Really the meat and potatoes of the guidance, it was the PPP interplay and the suspension of operations guidance that Adam and Jim just went through. So a few other nuggets, and we won't go into details due to the time we have left, but there was some clarification on the aggregation rules. Lots of questions in the Q&A about aggregation. Of course, this is a relatively complex topic that we don't have time to go into, but the new guidance we have around aggregation has to do with employees. And if you have more than one entity that is required to be aggregated, and you have an employee that had wages for both entities, you essentially can't claim more than the maximum credit for that employee. So you can't max them out in one entity and then switch that person over to the other entity and max them out there too. It's an aggregate maximum. So that's really the takeaway from this slide. The other more substantial guidance that we have in the notice has to do with the substantiation requirements. So we're not surprised by the list here. All the stuff, the IRS is basically saying you should maintain records to substantiate the ERC, including how you determined that you were an eligible employer, including how you came up with the wage computations, especially for large employers, in terms of who's getting paid and not working, that sort of thing, documenting your health plan expenses, et cetera, et cetera. So really the IRS is just putting you on notice that you need to have records and documentation to support your claim. What were we hoping for that we didn't get in the guidance? So just a quick list, and we've alluded to some of this already, but so far we don't have the 2021 specific guidance that will be forthcoming. We also, people have been asking about in the Q&A about the procedures and methods for claiming the credit. We were hoping that the IRS would allow for a method to claim the entire 2020 ERC on one amended 941X, or even on the current filing, and that was not part of the guidance. So fingers crossed that still comes at some point, but right now, the way to claim the 2020 credit, if you haven't done so already, is to amend each quarter separately. And then this whole 280C add back, again, more than we can go into here, but essentially you have to reduce your otherwise allowable deductions by the amount of the credit on your income tax return. So there's an add back to income essentially. Right now, we're recommending that the add back correspond to the same year that you're claiming the credit. So if you're amending your 2020 941X to claim a 2020 ERC, you'll likely have to make that add back on your 2020 income tax filing. So if you haven't filed yet and are planning to claim the ERC, highly recommend that you extend your tax returns. You can figure out that number. If you've already filed, likely would need to amend. Again, we're hoping for some relief on that as well, but that was not part of the notice. In the last 4 minutes, we'll give a crash course on the new law. So the American Rescue Plan of 21 passed the House of Representatives yesterday. So it's been passed by both houses of Congress, and it's expected to be signed tomorrow by President Biden.
It was just signed, Joe.
Oh, signed today, a day early,
Just signed. Breaking news.
Awesome, thanks, Adam. I have not been watching my email. I've been trying to answer all these questions, so thanks for chiming in there. So now we need to update the slide, but this is officially the law. It extends the ERC through 21. So now we have 2 more quarters. Q3, Q4 are now eligible. Some very similar rules in terms of the maximum $10,000 per quarter, 70%. So we're looking at an additional $14,000 of potential additional credit for each employee. There are, Congress decided to monkey with the rules. So we have some more fun rules to talk about. The most substantive thing that they inserted was this definition of a recovery startup business. And it's a new way to qualify as an eligible employer. So on top of either the gross receipts test or the suspension of operations test, if you are a recovery startup business, you can also qualify. Again, this is only for Q3, Q4 of 21, so this does not apply to any earlier quarters. And essentially, if you open business after February 15th, 2020, and you don't have gross receipts more than $1 million, you are automatically qualified, whether or not you've had a reduction in gross receipts or a partial suspension of operations. The credit is capped per quarter at $50,000 per employer. So the most you'd be able to get for Q3, Q4, assuming you had enough employee wages paid, would be $100,000 combined. The other change that we're seeing here is this concept of a severely financially distressed employer. And this hopefully won't affect most of you, but if you've had a 90% decline in Q3, Q4 of 21 compared to 19, you are exempt from the large employer rules around wages paid for employees not working. So essentially, if you've had a huge drop in gross receipts, you can claim all wages paid even if you're over that 500 employee limit. There's a couple of clarifying things. The shuttered venue operator grants, you can't, and this is part of the year-end Consolidated Appropriations Act, you can't take the same wages for ERC that you're using for the grants for. That's really targeted toward like movie theaters, performing arts centers, that sort of thing. And then part of this new law is a restaurant revitalization grant. And again, you can't claim the same wages for ERC that you claim for those grants either. And I guess my last note on this is the statute of limitations is extended. I think that Congress is realizing that this is more than the IRS can look at. There's lots and lots of companies and employers claiming this, so they've extended the statute for an additional 2 years, so it'll be a 5-year statute. We've been trying to answer as many questions as we can. Adam, Jim, anything that you saw in the Q&A that you'd want to address quickly as we wrap up?
Nothing on my end. Just thanks everyone for attending. And if we didn't get to your question, I always say make sure to reach out to your local Eide Bailly professional first. We'll try to get to them as well, but there's a lot of questions out there. So start maybe with your local Eide Bailly professional.
Thank you. Thank you so much for your time.
Yeah, thanks everybody.